Hi everyone, I wanted to make a video series about stocks and options and just investing in general. So this is going to be the first video of what I hope to be just a never-ending financial education series of videos. I'm going to be using a drawing tablet to kind of talk about and illustrate some of my thoughts and just give you a hopefully good explanation of how the stocks and options work and how to go about investing, whether you want to use this as a side hustle, whether you want to try and make this your main job, even though it's very, very difficult to do, or if you just want to learn a little bit more about investing for retirement, or maybe even retire early and become financially independent. So I wanted to create a video series. This has been asked for a lot in our Discord server and just in some of my earlier videos in general. So let's start off by addressing the big question here, and that is really, what even is a stock? Meaning, all this talk in the news about stocks and the stock market, what even is a stock? Well, a stock is partial ownership in a company. So when you hear your friends or people on the news talking about how they own Google or they own a part of Facebook, this is what they're referring to. It's partial ownership of a company. Now, owning a stock gives you the right to do a few things. So what happens when you own a stock in a company? Well, you have the first thing is you can obviously sell it whenever you want. So you have the right to sell that stock, hopefully for a profit, whenever you want. So that's obviously the first benefit of owning a stock, to try and make money. And so the second benefit of owning a stock, you get the right to vote in a shareholder meeting. So not many people know this, and not many people actually take advantage of this. But if you own shares of certain companies, you'll actually get an email when the earnings call, usually the annual earnings call, is coming up, and you can vote on a few issues. You get the right to vote in company meetings. Now, this is not mandatory, meaning you don't have to do this, but if you want to, it's available to you if you own some shares of the company. Now, the third thing that happens when you own stock, and this is not for all stocks, but you also have the ability to receive dividends. Certain stocks offer dividends, not all of them do. And I'll show you a quick Google search will let you know which companies offer dividends and how much the dividends usually are. But dividends are not 100% guaranteed. We'll talk about dividends in a future video, but there are certain companies that have offered dividends for the past 10, 20, 30, or even more than 30 years. So they're relatively guaranteed to continue offering dividends. So that's really what a stock is a partial ownership of a company. And it really affords you three main rights: the right to sell a stock whenever you want. And actually, I will put in a little parentheses here, hopefully for profit. I mean, you can also sell it, cut your losses, but we're all here to hopefully make money. So hopefully we're buying and selling, buying low, selling high, hopefully at a profit. Having ownership in stocks also gives you the right to vote in company meetings, like we said, and also have the ability to, if the stock offers it, to receive dividends. So let's look at an example of a stock. So if you're familiar with the company Lululemon, they make athletic clothing. Now, I know the ticker symbol for Lululemon is LULU. Stocks usually have ticker symbols made up of 1 to up to 5 letters. And usually, if you read them online, you'll see them with a dollar sign in front of them. That just tells you that they're talking about the ticker symbol. So other ticker symbols you may have heard of would be Google, going to be GOOG, maybe Tesla, SLA, Apple, which is AAPL. Pretty soon, you're going to have these ticker symbols memorized. But for this example, let's take a look at Lululemon, ticker symbol LULU. Right now, the price of Lululemon stock, $335.27. So if you want to buy one share, you have to pay that much money. So that is going to get you one share of the company. Now let's say you had exactly $335.27 you want to invest in the company. then you could go ahead and buy 1 share of Lululemon. Now, I know from a quick Google search that right now there are a total of 130 million shares, capital M is for million, of Lululemon that are issued out there in the world. So there are a total for people to buy, they may have already bought them, 130 million shares. And actually that number is what's referred to as float, in case you've heard that term before. The float means the total number of shares that are out there in the world. Now let's say you buy your 1 share for $335.27. Well, using these two numbers, that means that you own 1 share out of the 130 million that are out there in the world right now. So that means that you are the proud owner of 0.00007% of the company. So congratulations, you are now a part owner of Lululemon, albeit a small owner. But even just owning this 1 share, like we just talked about, you have the right to vote in shareholder meetings. Lululemon does not issue dividends, but if they did, you would have the ability to receive some dividends. And let's say you want to sell this stock tomorrow, hopefully at a profit. You are more than welcome to sell that stock whenever you want. So these are some of the benefits of what happens when you own a stock. Now, as a quick aside, if you're doing a little bit of reading online or watching other YouTube videos, you might hear people refer to stocks as equities or maybe even securities. These are all synonymous. They all mean the same thing. So whether you're hearing equities or securities or stocks, they are all referring to the same thing. So don't get confused about that. I'm going to refer to them as stocks just to keep things nice and clean. Well, so now you might be asking yourself, if you have publicly traded companies where the general public like you and I can buy and sell shares, but you also have private companies that are not publicly traded on the stock market, why would some companies want to be publicly traded and why would some companies want to remain private? So basically the question we're asking here is, why are some companies traded publicly? We'll call them publicly traded companies. And the answer to that question, I'm going to tell you in the form of a story. Let's take a look at a lemonade stand that's been started by little Susie here, okay? She was enterprising and wanted to start a lemonade stand in front of her house. And so what she did was she spent $25 of her own money, and she had to buy supplies, right, for her lemonade stand. So what supplies did she need? Needed obviously lemons, needed cups, needed water, gonna need sugar, gonna need napkins, and so on. So she has to spend money for supplies for her to be able to make and sell lemonade. Well, Susie did really well this summer, and after accounting for all of the costs of her supplies, she made a total of $25 of profit this summer, meaning she was able to sell out of her supplies at a premium, and she made $25 of profit. Well, that's great, right? So maybe she can do the same thing next year. But she sold out all of her supplies. If she had more resources, if she had more lemons and cups and sugar and water and napkins, maybe she could earn even more profit next year. So Susie needs to raise more money because right now she has only $25 of profit. Even if she puts that back into her company, her lemonade stand, she still may not have enough supplies for next year. So Susie wants to grow her business now for next year. And in fact, not only does she want to sell lemonade, but now she wants to sell orange juice as well, freshly squeezed orange juice. She wants to expand her business. But now, like we said, she's going to need more capital. She's going to need to raise more money. So what does Susie decide to do? She decides to sell shares in her company, Susie's Lemonade Stand. So what she does, she's going to sell $100 worth of stock. Let's say that's what she's calculated she needs. She needs $100 for next year. So she's going to sell $100 worth of stock in her company to grow the business. She's going to sell her shares for $1 a share. So basically, Susie is going to issue 100 shares of her company, Susie's Lemonade Stand, at $1 a share. So she needs to sell these off in order to get her $100. So she's going to go to her friends, her family, and she doesn't have to go to 100 people. Maybe one person wants to buy all 100 shares for $100. Well, now, let's say she sells off her shares. She's taken the $25 of profit from last year. Now she has a total of $125 in order to buy supplies, sell her lemonade, sell her orange juice, and hopefully make even more profit next year. And that's why companies would become publicly traded, so they can issue shares of stock to raise money for their business so they can grow it and hopefully make even more profit in the years to come. Now you might be asking, well, what's in it for the guy or the gal that bought, let's just say, all 100 shares of her offering? Well, the hope is that if Susie's Lemonade Stand does really well, then the stock price will go up. So maybe next year, her stock is going to be worth not $1 a share, but maybe it's going to be worth $2 a share. So now the person, let's just assume it's one person that bought all 100 shares. Now their initial investment of $100 is now worth $200 because it's $2 a share. That person owns 100 shares. So now their investment is worth $200. They basically doubled their money by investing in Susie's company. So it's a win-win scenario in that Susie's Lemonade Stand can raise capital so that her business can grow. And also the shareholder, or the person that bought her shares and invested in her company, essentially became a part owner of her company, can also make money in the stock market. And let's say that person decides to sell off his or her shares. Well, they've now doubled their money. They've turned $100 into $200 in a year. So everybody wins. Now, this is a very simplistic idea, obviously, but the general concept is the reason why companies offer shares of their stock and how you as an investor can benefit when the company does well. So what are the key takeaways from this video? Well, there's basically three key takeaways. One, that a stock is a security that indicates that the stockholder or the shareholder has proportionate ownership in the issuing company. Companies are going to issue stock to operate their business and growing it. And also, as a last point here, historically, stocks have outperformed most other investments over the long term. I hope you enjoyed this video. The next video is going to be on the stock market and what exactly is the stock market. I hope you enjoyed this video. Leave me some feedback below. Also, leave me ideas for what other videos and concepts you want to see in the future. Make sure you join the Discord server if you're not in there already, and I'll see you in the next video.